Well, what's really interesting about the Aussie resi market is it seems to be surging. Over the last 3 months, house prices are up 4% alone. That's a 16% annualised pace. Year on year to 18 May, Aussie house prices are up around 10%, which is much higher than the RBA expected. We've actually upgraded our forecasts for house price growth in 2016 from what was in December 1 to 2 times wages growth. Wages is running at 2%. To significantly higher than that on the back of the RBA's rate cut. You can now get home loan rates around 3.7%. Auction clearance rates are storming higher, or at least maintaining extremely high levels, around 75% in Sydney and Melbourne, which is quite unusual during the winter months, which are normally much slower. And I don't think there's any doubt that the second half of the year is going to get a significant tailwind, given the RBA's excessively accommodative monetary policy, particularly if they follow through and satisfy current bond market yield curve pricing for a second cut. I think this is largely being stimulated by an artificially cheap price of money, so home loan rates are just too low. And in Australia, it's quite unusual. Around 80% of all borrowers in the home loan market are variable rate, and those variable rate products price off the RBA's overnight cash rate. The reason that's unusual is because in most other countries, if not all, there's a much larger proportion of fixed rate borrowers. So in the US, for example, you have 30-year fixed rate home loan products that dominate, and they price off the 30-year yield curve or the long-term price of money, and that is much less directly influenced by a central bank changing its overnight cash rate. So during the GFC, the RBA sort of boasted about the potency of Aussie monetary policy because it flows through to variable rate borrowers immediately. Those 80% of homeowners that have variable rates, they get that cut straight away. Whereas in the US, if you've got most borrowers on fixed rates, they get no benefit at all unless they refinance their loan. Now, obviously that potency, I think, is starting to manifest again, where we've got the lowest rates in history. I mean, the nadir touched in the GFC in April 2009 was 3%, and the cash rate then rose to 4.75% by November 2010 because the RBA was worried about over-egging the housing market over 2009 and 2010. We had very strong house price growth. This time around, they've been over-egging the housing market since 2013, so we've had double-digit house price growth pretty much every year for the last 3 years, and yet they're cutting the cash rate to 1.75% and potentially even lower. So I think you're going to get significant distortions in the decision-making behaviour of investors.